This is Daniel Lacalle, chief economist with the Tressis Hedge Fund with over $6 billion of assets under management. Lacalle also wrote Escape from the Central Bank Trap. Daniel, great to see you. Thanks for coming on.
Thanks for having me.
Daniel, we see the Bank of England raising rates today. Yesterday, we had the Fed looking to taper and tighten even faster. What are the big changes going to be for the real economy, do you feel?
I don't think that there's going to be a massive impact on the real economy. Remember that when central banks start to raise interest rates, already commercial banks have probably started to raise interest rates for their customers. And we have seen anyhow that in the US, the UK, in the Eurozone, credit demand was slowing down significantly in 2021 and to a normalized level, nothing negative about that. So I think that they're being extremely dovish in this sort of acceleration of tapering anyhow. If we look at what the Fed is saying, interest rates will be in the United States at 2.1% in 2024. So that means very far away from where inflation is. And in terms of the reduction in bond purchases, if we look at what the Fed or the ECB have said that they will do, they're going to continue to purchase more than 50% of the net issuances of the sovereign issuer of the Treasury and the member states of the Eurozone. Therefore, it's a very dovish, hawkish message what they're sending. They're just being very, very prudent.
And how about the financial markets? Are you taking a more defensive position at the hedge fund?
We are looking to have a more defensive position fundamentally because we think that the more cyclical stocks and the more cyclical assets have run their course. So we have taken money out of commodities, out of cyclicals, out of everything that has to be uh, uh, expected to rise significantly because of inflationary pressures or because of more improvements in margins. So more defensive, less exposed to emerging economies, less exposed to the Eurozone, more exposed to the United States, and less exposed to the economic cycle, yes.
We see that even the NASDAQ and the tech stocks continue to rally. You expecting this to continue?
Well, in the case of the Nasdaq, it's an interesting index because about 90% of its return has been created by five stocks, no? And those five stocks continue to have very strong fundamentals, and we're living it every day with the use of technology and the use of their applications, no? So I think that that divergence between a few of the stocks and the other components of the index, as well as the Nasdaq versus cyclical and value stocks, I think that will continue, yes.
And say if the Fed, as planned, they reduce and they eliminate their bond purchases by next March, the ECB eliminates their bond purchases by next March, are you expecting the stock market to correct a little bit, or you think we just won't see the levels of growth that we've been used to over the past 18 months?
Well, the first thing that we need to understand is that none of the central banks are going to stop entirely their purchases. They're reducing their purchases. So even in the most, let's say, aggressive estimate of what they will do by March, they will continue to repurchase in the region of 40 to 60 billion a month between the Fed and the ECB. So it's going to continue to be, unfortunately, an environment of financial repression, and that certainly is positive for equities and for risky assets.
And finally, we had Danielle DiMartino Booth on the show yesterday. She talked about recessionary risks and signals that she's seeing in the economy. Are you worried about a slowdown, possibly recession?
I think that the risk of a slowdown is very evident. We are seeing it, for example, the PMIs in the Eurozone are coming down aggressively, both manufacturing and services. The US economy is a little bit stronger, but there are also warning signs in the manufacturing sector and in the smaller companies. So I'm worried about the slowdown. Absolutely, I am. But I don't think that next year will be will be a recession. I think it's still difficult considering that there are strong tailwinds in the economy, but definitely slowing down in job creation, and certainly slowing down because of the elevated levels of debt accumulated throughout these last 5 years.
Thank you for watching this video. Please subscribe to my channel, like my videos, leave your comments below, and keep defending freedom. Thank you very much.